Welcome to Financial Ratios, Current Ratio. By the end of this ACLET, you should be able to use applicable financial statement data to calculate the current ratio. Here are the comparative income statements and balance sheets for Harrington, Inc. We'll focus on the current ratios for 2016 and 2017. We'll work through the 2017 calculations in detail, but provide just the check figure for 2016 so you can work 2016 to test your understanding. The current ratio measures liquidity, how easily a company can come up with cash. More specifically, the current ratio indicates whether a company can pay its current liabilities with its current assets. The formula for the current ratio is current assets divided by current liabilities. Which financial statement reports assets and liabilities? The balance sheet. If we had a classified balance sheet, our job would be simple. We'd pick up the numbers from the total current assets and total current liabilities lines, but you are not so lucky. We don't have a classified balance sheet for Harrington, so we have to go through the assets line by line to find the current assets. Then we'll have to do the same in the liabilities section. For 2017, the first asset is cash. Cash is always a current asset. Next is accounts receivable. Since we would assume that Harrington, like most companies, gives its on-account customers 30 days or so to pay, we assume that the receivables will turn into cash well within a year. So receivables are a current asset. Inventory is next. We assume that Harrington hopes to sell its inventory well within a year, so inventory is a current asset. Prepaid rent is a prepaid expense, which we can assume is a current asset. Then we have equipment. We assume that Harrington is not planning to sell its equipment in the next year, so this is not a current asset. And accumulated depreciation on the equipment goes with equipment. When you add up the 2017 balances for the four current assets, you should get total current assets of $108,900. Now we'll go through Harrington's liabilities. The first is accounts payable. Most suppliers will require payment in 30 days or so this is a current liability. Income taxes payable will have to be paid well within a year, so this is also a current liability. Bonds payable are usually used for long-term financing, so we assume this is not a current liability. When you add up the 2017 balances for the current liabilities, you should get a total of $73,280. When you do the division, you get 1.486080. We've recorded more decimal places than we need, but no problem. We'll round our final results to one decimal place. A review of rounding. Identify the digit that we care about, the one that we will be rounding to, so one place to the right of the decimal point. Then look one place to the right of the one we care about and ignore everything after this. Is the one to the right of the one we care about 5 or higher? If yes, the digit we care about will go up. If no, the digit we care about will stay as is. Since 8 is 5 or higher, the digit we care about, the 4, will go up. So our final result, rounded to one decimal place, is 1.5. Is 1.5 a strong current ratio or a weak one? Is Harrington able to pay its current liabilities with its current assets? One current ratio by itself doesn't tell us much. We need to be able to compare it to other current ratios, either for the same company, for example Harrington's 2016 current ratio, or to Harrington's competitors. We can say that in general, we'd rather have a current ratio on the higher side rather than on the lower side. When you calculate Harrington's current ratio for 2016, you should get 1.4. Did Harrington's current ratio improve or deteriorate from 2016 to 2017? This concludes the ACLET, Financial Ratios, Current Ratio.